I'm Matt Busch with NAREIT here in Hollywood, Florida for NAREIT's REITwise, the 2018 Law, Accounting, and Finance Conference. Joining me today is DJ Busch, Managing Director with Green Street Advisors. DJ, thanks so much for joining us.
Thank you for having me.
Now, obviously we've seen a lot of changes going on in the retail market. First, how do you think landlords are positioning themselves to adapt to all of these changes?
Well, there are a lot of changes going on. I think one of the primary ways the landlords are changing is by prudent portfolio management. So over the last couple of years, we've seen managers go through by asset within their portfolios and decide whether those properties are ones that they want to invest further in to position them for the future, or are they candidates for disposition. So we've seen a lot of the retail REITs over the past several years be active sellers. And I think we'll continue to see that as the bar is getting higher on what qualifies as quality in the retail space. But if you look back, 5, 3, even 2 years ago, the portfolios today are much higher quality and better positioned than they were in the past.
Now, picking up on that note about quality, what's the importance of property location and its influence on fundamentals and valuation?
Well, property quality and location quality are really everything, especially if you think about in retail. As retailers probably get more selective on where they want to do business going forward, we're trying to get better at Green Street on understanding the quality of the locations that these retailers are deciding to do business. What we've done is we put a lot of time and effort into trying to get better at that, and at Green Street we just actually launched a product called Atlas, which is really an interactive mapping and analytics tool that lets us evaluate locations and their relative attractiveness across not only sectors but geographies.
And what is the most important thing for retail REITs to keep in mind in this current environment?
Right now, it's really just to keep a very strong and solid balance sheet and have ample access to capital, because as we go through the transition in retail, and there's going to be more transition and shakeout, the ones that are able to invest and have solid balance sheets and capital structures are the ones that are going to be able to separate themselves from the rest of the group going forward.
And lastly, two-part question. What are some of the most positive things going on in the space, and what are some of the challenges that are still out there?
So one of the big positives is there's a lot of exciting new retailers coming to market. The reality is that they're just not opening as many stores as they have been in the past. But a lot of these digitally native or concepts that were born online are now looking to open up and have a physical presence. And the good news about that is that these retailers already know where their customers are, and they already have the data available and are much better positioned to, when they do go to market, to be successful. But there is a lot of interesting and new concepts that are looking to take space. The challenge really is that there's a lot of big retailers that may be still looking to downsize or close stores, or maybe even have more distress like we've seen just recently with Toys R Us. Those are inevitable and they will happen, so there's going to continue to be this uncertainty and transition as we move from kind of the old guard to some of these very exciting new concepts.
DJ, thank you so much for joining us.
Thank you for having me.
For more from REITwise, be sure to visit NAREIT's website, REIT.com.